welcome to the Fogarty Innovation session on charting the course for Medtech, exits and investment activity in 2020 and expectations for 2021. Hi, I'm Andrew Cleeland, CEO of Fogarty Innovation, and today I have the pleasure of working with Jon Norris, Managing Director of Silicon Valley Bank. We all know Jon, but I'd love him to give us a little introduction, please.
Great, thanks, Andrew. Great to be here. So I've been with Silicon Valley Bank since 2006. I'm a managing director focused on the healthcare practice, and really my job is to interact with the healthcare venture community. So I'm sitting down and chatting with folks on a day-to-day basis about how they're deploying capital, how they're thinking about their investment thesis, and then also talking a lot with companies about how they're thinking about their financing plans. So at SVB, we work with companies from idea on a napkin, pre-funded through Series A, all the way up through public big companies. And as I said, I focus on the healthcare sector, and happy to sort of walk you through a little bit about what we see actually happening out in the market. We put together a paper twice a year that really goes into investment thesis and where people are putting their money, as well as what's happening on the exit side. So happy to sort of give you a sense of what we're seeing in the device world.
Yeah, so I'm really looking forward to it. I got to tell you, Jon, that every time we go to industry conferences, one of the things that I'm most interested in looking at is this presentation that you prepare. So why don't we get straight into it if you can?
Again, this is a part of an analysis that I do on a semi-annual basis, but today we'll sort of be much more focused on the device side. But maybe to just start you off with giving you a sense of how we're interacted into the venture market. This is from last year's paper, but really, of all the financings that happened in 2019, we bank or work with about 50% of those companies that financed. And of the folks that raised really big rounds of 50 million or more, we work with about 66% of those folks, and work with 63% of the folks who have IPO'd in sort of the venture healthcare realm. So just to give you a sense, we are really working with a lot of companies, which gives us one sort of access to working with a lot of great entrepreneurs and investors, but it also means that we see a lot and we get a sense of trying to figure out what are the trends that are emerging in the sectors, and how does that sort of affect not only the investors that are putting money into companies, but also the companies themselves and how they're raising funding and thinking about the exit environment. So, maybe with that, we'll sort of get into the first slide. So this slide looks at venture fundraising. And so we look at every single venture fund out in the market and say, okay, you closed your venture fund. Are you investing in healthcare or not? And then based on sort of historical portfolio allocation, how much of that fund do you think you're going to be investing into healthcare? And so that's what the numbers that you see down here are. And you can see, these are, again, dollars raised for investment into healthcare. And you can see over the last 5 years or so, a really healthy up and to the right in terms of dollars closed by venture funds to be invested into healthcare. And it culminated sort of last year with $10.7 billion raised. Through the first half of this year, really an amazing sort of event occurred where venture fundraising for healthcare was at $10.4 billion just at the first half of the year. So it almost equaled the record year number for 2019, which really, in a sense, just means that there's a lot of capital out in the market, really predicated on great returns that investors have seen over time. But if you think about it, $21 billion fundraised in the last 18 months, and all that capital from those venture firms are going to be focused on investing into new portfolio companies for them. Now, it could be Series A, could be later stage, but that's a lot of capital to be put into the market, into new portfolio companies.
Can you help me, Jon, with your definition of healthcare here?
Yeah, no, great question, Andrew. And when healthcare, in terms of what I characterize or define as healthcare, it's biopharma, it's medical device, it's tools and diagnostics, and also health tech. All those sectors sort of, to me, come up and sort of come into the definition of healthcare. And if you look at the bottom of this slide, I sort of tried to pick out some of the folks that have raised so far this year that do have a device-focused investment thesis, at least part of how they're deploying capital. So you can see there's a lot of firms out there that have new capital that are focused on medical device investment.
It's looking very healthy.
Yeah, a lot of capital out there. And so let's transition to overall, the first slide looking at dollars fundraised by investors. Now let's look at where are they actually putting those dollars to work in companies. And so this gives you a sense by the 4 different sectors that we cover, where the dollars are being invested. 2018 was a huge upswing over what we saw in 2017. So this $32.8 billion really is a record for the healthcare industry for venture. And in 2019, with a couple of late really big deals, they actually eclipsed that number to $33.6 billion. And so basically 2020 was really set up to be a big year for dollars to be invested into companies and actual investment activity. And then, COVID hit, the pandemic. And so what was really interesting, you saw Q1 here, just an amazingly big quarter for investment into the sector. And when Q2 and the pandemic hit, I don't think anyone really could have predicted that we would continue to see the amount of investment that we saw in Q2. All of a sudden, face-to-face meetings were limited. You're doing everything on Zoom, revenues being impacted pretty significantly, clinical trials enrollment and progress being limited. And so with all those headwinds, we saw actually really incredible sustainability in investment in all the sectors. And if you look specifically within device, while all the other sectors are actually poised for record years, device is on pace to be similar to what we saw in 2019, and eclipsing what we saw in 2018. And actually, if you include Q3 numbers into these numbers, actually device is on pace to set a record year as well. So despite what we saw in COVID, as potentially a limiting event for investment into companies, it's actually has had no effect. And we are on a year to set a record in every single sector within the healthcare venture industry.
I think you made a comment there about Q3, and so Q3 you think is actually increasing. I would have expected that the Q2 numbers would have been marginally impacted by COVID, just because diligence, everything else probably would have been done earlier in that process, and they were just executing deals. So Q3 would have been where we would have expected an impact, and apparently we're not seeing one.
No, and we'll get to those slides in just a second. And yeah, I think that's a fair point, because you do have sort of the deals that are in the queue that maybe need time to get legally docked and actually have the press release come out, et cetera. But yeah, Q3 has actually been a lot better than what I would have thought. So let's sort of get into that. And we'll start with Series A. We basically, on the financing side, have 2 different slides that we look at. We sort of look at Series A, and then we look at total investment in the sector, which includes the later stage deals. And so in Series A, I think, the takeaway there is that we're lagging in 2019. And so if you look, in 2020, if you look at the overall dollars through Q3 and deals, we're at 57 deals at $443 million. And it's a pretty far cry from what we saw in 2019 at 105 deals and $770 million. One interesting thing is actually Europe has actually been, pretty stable so far this year. But in the US, we've actually seen a pretty significant decline in Series A activity. And you can sort of see down here the top indications over the last 3 years and the number of deals in dollars. If you sort of go over to this sector, you can see, imaging is down from what we saw in 2019. Cardio is actually pretty significantly down, which is really surprising, because, that's where we're seeing a lot of good exit activity. Neuro, on the other hand, as well as non-invasive monitoring, surgical, and even in drug delivery, which is sort of patch-based technology, we've seen increased investment. And frankly, the biggest deals that we've seen out there are kind of small in comparison to what we've seen in previous years in terms of size of these Series A. Certainly nothing to turn your nose up at, but $30 million, CardioMech at 19 million, and Reggiani at 15 million. Those are the top 4 deals in Q3, which are kind of smaller deals. If you look at in comparison to what we've seen in previous years on a quarterly basis, you get a few deals that are in the 30, 40, $50 million Series A, and we're just not sort of seeing that.
I'd love to get a 30, 40, $50 million Series A. I don't think I've seen them before, so that's good.
Yep.
All right.
No, I hear you. But if we look overall in the sector, I think one, getting to your point that we talked about a couple slides ago, through Q3, we're at about $3.7 billion, which puts us on track to exceed probably slightly the record dollar amount of $4.7 billion that was invested in 2019. Less deals probably, but overall more dollars in. And, by indication, I think it's pretty interesting. While you saw not as much activity in Series A for cardiovascular, a lot of late stage investment in cardiovascular is happening. So we're seeing that sort of at even progress versus what we saw in 2019. Surgical is down, but neuro is up, especially sort of in neuromodulation technologies. You're seeing a lot of activity in that sector. And orthopedic, where we continue to see exit activity there, but that exit activity has tended to be on the lower side when you look at the dollar amount that these companies take to get to sort of revenue ramp and exit. The output of the exit is not really representing great multiples on how much venture investment has been put in those companies. And we are seeing that reflected in a little bit less investment in that sector so far this year. A couple other interesting indications just to sort of throw into the mix. One, on the tissue regeneration side, 13 deals and almost 300 million. On non-invasive monitoring, which we had continued to see a lot of activity in Series A over the last 2 to 3 years. Those companies have kind of graduated and started to raise these really big Series B and Series C rounds. And so to see, 30 deals and $535 million through Q3 is really interesting. A couple other points, one, you're seeing sort of these MES rounds before IPOs happening. And there's a lot of what you can take as, COVID-based opportunities for these late stage investments, because you see a lot of these companies that are really performing well in terms of revenue ramp and maybe on track for an IPO. When the pandemic hit, all of a sudden, the IPO ability of these companies was put into question. And two, obviously, the revenue run rate and where these companies were sort of headed in terms of projections and getting to cash flow positive and profitable, et cetera, were sort of, a big question mark thrown up. And so I think that ended up being a really interesting opportunity for late stage investors, both venture folks as well as sort of the MES investors, to jump in to provide additional capital for these companies because they just weren't sure when that IPO opportunity was going to happen. And so, for companies like Pulmonx and Eargo raised, sort of pandemic timed investments and then went public. And Outset Medical obviously raised some money earlier in the year and then went public and have done very well. And it was sort of the idea of a safe play for these companies to raise some additional capital just in case, the IPO opportunity wasn't going to be apparent down the road.
I think that, and I think you're going to touch on it in a moment, but it is introducing, as you just said, a new series of investors here. The mezzanine level investors. That I haven't seen for a little while. So.
Yep, and that sort of leads to the next slide, where we look at where these folks are investing and how they're investing. I think there's a lot of folks on the venture capital side that are familiar to everybody, but you have a firm like Shangbei Capital, who actually has the most venture deals. They're sort of a smaller player, but they're very active in the market, especially in Northern California. But they've also been, the venture folks have been, there's a collaboration, what we're seeing for some of these late stage investors, specifically folks like Deerfield and Cormorant, that while you could call them late stage, sort of either late venture hedge fund or pure hedge fund like Cormorant, they are being interested in investing in early Series A device deals, which I found very intriguing. You know, obviously Deerfield has a device fund that's focused on investment and have done some early stage deals, but Cormorant has partnered with Shifamed to do some really early stage device investing as well. So while these folks are doing a lot of these late stage deals, there is some interest in those folks getting a little bit earlier. But if you look at the end, you know, who has participated in the biggest deals so far in 2020? Here's a list of the investors in the top 3 or 4 deals that we've seen so far in 2020. And most of these folks are sort of the late stage mezzanine hedge fund sort of folks that we did see being very active in biopharma, sort of make a transition to also look at opportunities in device. And they're doing that because I think they believe that there's great opportunities to IPO, which we'll talk about in a little bit. So with that,
and this is,
oh, go ahead.
Yeah, maybe before we jump into the next slide, maybe just summarize what we've seen so far with investing. And I think, you know, a couple of things to note. We've seen more money raised by VCs than we've ever seen before. Deals and capital invested in medtech is on track for a record year. However, you know, I think this is important to point out, that's primarily driven by late stage investment, particularly by these larger players, Deerfield, Inverse, Redmile, and the like. Series A, which is, you know, sort of in the world that I live, a little slow. Yeah, I think it's fair to say just a little slow. And again, probably not surprising. Valuations are going to be, I think, as we had discussed before, you know, so the deals are there, the capital is there. It'll be really interesting to see what the valuations are. Are our entrepreneurs being hit by lower valuations? We'll see. I think the biggest takeaway for me is, you know, we've been living with COVID now since March, and it appears to have had minimal, if any, impact. You know, what's your take on that?
Yeah, I think that that's really spot on, Andrew. And you know, it's been surprising to me to see the lack of hit that financings I would have predicted would have taken based on COVID-19 and sort of the shutdown and their inability to meet face to face. But I think it's sort of the resilience of the sector that we have, as well as, you know, the fact that it is a pretty tight network of folks. And so even though you're not meeting these folks face to face, typically there's one phone call away to someone who you know really well that knows this company or this team really well. And I think that's gone a long way to sort of helping healthcare as an overall sector continue to be pretty aggressive in terms of dollars being invested into companies. But I do, you know, to your one point finally on the Series A being down, I think, you know, those really are the seeds that are growing into the next wave of big companies. So to see, you know, the decline in that is a little bit concerning. And I think, you know, to be fair, there's a lot of those companies that are not as well known in terms of the management team to the traditional investors.
Yeah.
And so that's really the, you know, sort of maybe the step that we have to figure out how to solve, is to make sure that we're connecting really interesting companies with early stage ideas to the right set of investors. And so that's the one we're going to watch pretty closely.
An interesting thing that I've seen, you know, I'm looking at your list here on the left-hand side. I've seen Deerfield, I've seen Inverse, I've seen Fidelity, definitely Longitude, getting in very early into Series A's. So it may be what we're about to see when we talk through the exits and what we're seeing there. We may see in subsequent years more earlier investments as a result of you know, I don't want to give your story away, but you know, some promising exit history this year. So why don't we move into that?
Yeah, I think yeah, the final point I'll make is that maybe there's not a Series A prototypical investor anymore, you know, or a late stage investor. It's all about where the opportunity is and how to maximize value. And so maybe with that, you know, as we head in, you know, high flying IPOs make for continued strong returns. You know, you could say that on the biopharma side as well, but it feels a little strange to say that on the device side. But really, when we go through the slides, you'll get a sense of just how powerful that statement is and where we are in this sector.
Yeah, I do. Just looking at those two sentences side by side seems very strange. So that's good.
So let's sort of get into it. And I think, you know, when you look at, you know, 2020 into October, you know, mid-year M&A was down pretty significantly. We saw a little bit more activity in Q3, so things are looking a little bit better on that side. But, you know, having 10 IPOs through October with a record of sort of 11 in 2015 really sort of sets the stage for the opportunity for these companies to enter the public market. And, you know, what's amazing to me is if you look at, you know, one sort of the overall numbers here, the class of 2020 IPOs for device, the average IPO performance was 90%. So you look at what did these companies IPO at, what was the price per share, and then what are they trading at currently? The average was 90%, which, you know, is a great number. You know, the one thing that you sort of think about is, well, does that just mean there's a couple huge returners there that are averaging that number up? But when you see the median performance at plus 78%, that is a real eye-opening sort of number for me. So not only is average performance up, but even in the middle, you're seeing plus 78% for these companies. And then you sort of, your eye goes over here, which I'm sure probably the audience has already been looking at all these numbers, but, you know, only 2 deals that are actually trading below their IPO price. And look at the number of companies that are valued at over $1 billion. And again, this is just the class of 2020 IPOs. These are companies that have IPO'd this year. And some of them have IPO'd very recently. Look at Eargo, you know, IPO'd at $18 a share. They're up close to 34 with a market cap over $1 billion. So this is just amazing performance so far this year and is really exciting to see for the sector. But I think, you know, what's even more interesting is to say, okay, you know, in the area of COVID, you know, we've been able to see all these companies get out and they've traded really well. But what does that mean sort of as a historical perspective? You know, is this a one-off year? Is there just, you know, so much pent-up demand for interesting companies that every IPO is performing well? What's happened in the past and where do we think things are going to go? And so I think that's sort of an interesting way of sort of segueing into the last couple of years of IPOs to see where we've seen in terms of performance. And this is sort of, you know, going back 1 year, looking at the class of 2019. These are all the venture-backed device companies that IPO'd during 2019. And 6 of the 8 deals have $1 billion plus market cap. Or I'm sorry, 6 of the 8 deals are actually positive, and 4 of the 8 have $1 billion plus market caps. If we look at the performance again, these numbers are actually even better than what we saw in 2020, with an average of plus 166% and the median up over 100%. So, you know, only 2 deals are trading down, but look at, you know, a number of these companies are up over 200% in terms of performance, which is just amazing to see because, again, you know, this is looking at over, you know, for a lot of these companies, year and a half performance. And to see them still up at the type of heights that they are really show that these companies not only have had a nice pop to their IPO, but they've gone through a number of quarterly filings where they've been able to show sustained performance to the effect of continuing to hold on to the value of that first day pop.
Yeah, these are remarkable numbers. I mean, it's great to see. You know, looking at Silk Road, Shockwave there. Yeah, good on them.
And
that's remarkable outcomes.
Absolutely. And then so let's go back 1 more year and look at the class of 2018. Here, you know, again, you know, we're a couple years out now from these IPOs, and you know, the average is still a phenomenal 102%. The median has come down a little bit, But anytime you see a positive median for sort of IPO metrics, you got to feel pretty good at plus 27%. You know, a couple of these companies have not performed well, but you know, overall, we continue to see strong performance. You know, 3 of these companies are up over 100%. You know, we have 3 of them, or excuse me, two of them have $1 billion plus market caps, and actually, you know, the performance has been good. So I think, you know, my takeaway here is that, you know, overall, you have sort of 3-year data now showing really strong IPO performance, with sort of maybe a focus on looking at 2020 and seeing, you know, the ability of these companies to get out in a really, you know, difficult time period where revenues are impacted, where there's question marks about, you know, what those long-term numbers are going to look like. You know, I think the feedback is there's not a question that people aren't excited about these technologies and think that they work, and realize that the market will come back and be strong. And so these companies are able to go and access the public market, and we continue to see strong, sustained performance. So the IPO market seems like it's sort of functioning on all cylinders, and you know, it's great to see, because that is something that we've talked about in the biopharma category for a number of years now. To see that, you know, we're actually seeing just as good performance in the device sector as we see in biopharma in terms of IPO performance is really compelling.
Yeah, that's excellent. That was the last one, right?
That
Yep.
is. And so now you have the other side of the ball, which is sort of the private M&A side. While, you know, we see a lot of up and to the right on the IPO side, on the device side for M&A on the private sector, it's been a little bit less exciting. And if you're looking at the numbers so far this year, you know, at $80 million up front, you know, that's a little bit of a struggling number when you think about most of the time these companies are raising $40 to $50 million to get to exit. To see those numbers, it's the returns are really not quite there. I think what is interesting though is you can see that, you know, the time to exit in 2020 had a significantly quicker time than we've seen in any of the previous years. So I think what you're seeing is the ability of investors to quickly put an idea together and think about sort of a bifurcated strategy. Either you're going to go for the bigger mezz rounds and think about going public, or it's maybe you're adding a tool to a toolkit, getting to, you know, a quick iteration, and then finding an exit at a home at maybe a lower dollar invested amount. So yeah. I do think, you know, we're struggling a little bit on the M&A side, but really the question is, or the answer really is, you know, IPO seems to be carrying the day in terms of dollar value.
I wonder if, sorry, just a thought here is, you know, particularly with that low up front, and more importantly with the low years to exit here, you think that this might be where COVID's hitting, that these have become deals because of a funding concern, so they're willing to accept a lower value and exiting earlier than they normally would have.
Yeah, that's a super interesting point. I think that probably has a lot of merit, and I guess, you know, we'll get a sense of it as I start to sort of dive into the actual numbers as we get towards the end of the year and sort of go back and see history. I don't have that at the tip of my tongue, but that's a very, very interesting point, Andrew. And you know, maybe, you know, there's also the issue of, you know, who are the acquirers and do they have the capacity and interest in spending capital right now when they have to hunker down themselves and figure out, you know, how COVID is impacting themselves. And this is sort of the final slide that we have, which shows, you know, the venture-backed M&A arena and who the biggest players are and what they've done over the past few years. You know, there's a couple of interesting takeaways that we'll maybe end with here. Is one, you know, to see Medtronic, you know, back into the fray with a number of deals after not doing things for quite a while. To also looking at Boston, which was very, very acquisitive over the previous few years, but then has been a little bit quiet lately. And you sort of balance all of that with some of the big acquirers with the question marks of folks who have IPO'd over the last 5 to 6 years that have, you know, big market caps, a lot of cash in reserve, and may be on the acquisitive landscape. And we did see Intersect ENT buy more of a DX tools company earlier this year. It wouldn't surprise me to have these folks kicking some tires of some interesting emerging stage technologies and maybe add them as part of their overall growth plan.
Well, they've got the capital, it would appear. That's interesting. Yeah. Yeah. All right. Excellent. Maybe if you can hop out of the presentation mode and let's just go back to us for a sec. I think to me, John, the story of the year there is the IPO market. You know, I mean, I'm very surprised to be saying that, but historically the ratio of M&A to IPO has been in the order of 2 to 1, you know, at the least. This year, I think we're on track to see IPOs actually, both in terms of dollars and value created, you know, exceed M&A. It's remarkable.
Yeah, absolutely. And the dollar value for sure is going to be a big multiple of what you see on the M&A side. And it's, you know, I think it's a function of, you know, there's a lot of capital out there looking for interesting stories. You certainly have seen, you know, what we've seen from the pandemic in terms of affecting the financial markets and the ability of, you know, healthcare and emerging technologies there to really be at the forefront of some of solving some of the issues that are out there. And that's sort of propelled healthcare as a whole more into the public eye. And I think has really sort of sold the idea of emerging technologies as a really interesting area to invest in. And that certainly has been felt in the device side as well.
Yeah, love that analysis. I got to ask you, how long do you think this window is going to stay open?
Yeah, good question. You know, everybody's got their own opinion, and obviously there can be some macroeconomic impacts that could sort of shut everything down. But what I really look at is, you know, there's a reason why we continue to see pretty aggressive investing by these crossover investors in these mezz rounds. You know, really the idea is that, you know, those folks are investing early at, you know, a reduced valuation for companies that they want to push into the public market. And that's really the reason why they're making those investments. They're not really making it for private M&A. They want to push those companies into the public market and then ride performance. And so the fact that we're seeing so many of those investments still happening even through Q3 and into Q4 this year means that that's sort of your IPO pipeline. And that pipeline is pretty substantial. So I think, you know, absent these macroeconomic things that are hard to predict, that there still should be a lot of interest and a lot of appetite for these sort of emerging tech companies on the medtech side to think about entering the public market. So I think sort of the market is here to stay. I'm very excited that, you know, it's going to be a good end of the year, and I think we're sort of set up to have a good year in 2021. But again, you know, macroeconomically, it's hard to predict. But I'm certainly optimistic.
You've got to look, I think, and that was a good point before, to go back and look at the class of 18, the class of 19, right? Because if they had underperformed, then, okay, so the class of 20 might be the last one, but there's no reason to believe that. They've been performing well. So maybe we're seeing the beginning of a new era here. So, like, I got to say, you know, I've told you in the beginning, I've watched you give these presentations for many, many years. I love them. But this is probably the most positive one that I've seen in that time period in a year that I wouldn't have anticipated it. So I think that's, you know, what this is showing is our field is viable. The investment is for the long term, right? And so yes, while COVID is having a horrible effect across not just this country but across the world, it will be an event that we'll get through, and we're looking at these investments in for the longer haul. So I want to, you know, on that positive note, I want to say thank you very much yet again for a really cool analysis. I owe you a beer when we're able to actually go and get together again. But just, yeah, wanted to say thank you very much, and offer up that if anybody wants to ask any questions of either of the two of us, please direct all your questions to Jon.
All right. Thanks, Andrew. It was a pleasure.
Right.